Oh, here's Daryl Guppy of Guppy Traders with a very, very interesting first slide of the Desert Fox, Erwin Rommel from World War II. So without much ado, Daryl Guppy, ladies and gentlemen, I'm turning the floor over to him. You can ask questions while he is speaking, but I'm going to hold all the questions to the end, and then I promise you I will get to every single question you may have for him. Okay? Daryl, all yours.
Thank you, Boris. Good morning, or good evening, or good day, as the case may be. Most of you, I hope, will recognise Field Marshal Rommel in this rather classic photo. And I start with Rommel, the Desert Fox, because he is a master both of strategy and tactics. He's a good example of the way that both are combined to develop winning trading solutions. I will discuss what I do and why I do things in particular ways. I invite you to more closely examine your own thinking about the market so you can ensure that what you are trying to do, the indicators you use, the methods you choose, are the ones that are most compatible with your intuitive thinking about the market. And if there is a contradiction here, then trading becomes very difficult and usually a failure. I was fortunate enough in the early 1990s to listen to Linda Raschke speak in Kuala Lumpur. A week prior to that particular conference, my house had burned to the ground. However, I decided that this conference was important enough to warrant travelling from Australia to Malaysia. And I'm glad I made that decision because that conference was instrumental in forming some of my approaches to trading and to the market. Linda was part of Tim Slater's travelling group of technical analysis and trading experts. Tim Slater was with CompuTrack, for those who can remember that far back. She spoke of the way that she listened to the market, the music of the markets. Later, I came to understand that she meant that her understanding of the market was exactly compatible with the methods she used to trade those markets. It took me a while to reach this understanding, but this principle has become the basis of my strategy of trading the market, and that's where I'll start the discussion. At the same conference in Kuala Lumpur, I also listened to Joe Stowell, and from his discussion, I extracted a small gem that I further developed and polished and modified. It has become the foundation of my tactical management of trades. It's a self-adjusting volatility stop. I call it the countback line, and I'll discuss its place in my trading execution a little later. So bear with me for a moment or two as I start this discussion with some strategic observations because, as Rommel shows, without the map, we don't know where to strike. I'm just going to make sure I can get this done. There we go. Why is not this working? Nothing like a good technical issue just to start off with. There we go. If you can't make the rules of the game, if you don't know what the game is. So I want to examine very briefly what the game currently is, what the market really is. Then how we start off with a strategic analysis. From that will determine how we create a trading pool, a list of stocks or instruments or commodities or derivatives that we want to trade. Then how we can filter those to find the best trade out of that particular list, how we manage those trades, because that's really the secret of success, and the execution choices that we intend on doing. And that's really where I want to go in the next 45 minutes. What are you? Are you a pirate or are you a gold miner? It's an essential difference in the way that we approach the market. It's not something that can be easily dismissed. What's the difference? A gold miner tries to mine the market. He tries to find nuggets of gold, nuggets of opportunity before anyone else. So the tools and the methods that you use for that search are very, very different from the tools and methods that you would use for other sorts of searches and other ways to tackle the market. It takes an awful lot of work, and some people are very, very good at it. Some people are maybe not so good at it. A pirate, on the other hand, focuses on where the treasure has already been found. Now, of course, in the old days, the favourite method of piracy was that you would attack the gold treasure ships that were the Spanish ships that were sailing between South America and the Philippines and onto Europe. And the Philippines was a major pirate base for that region. This is my preferred method. My preferred method is not to spend a lot of time gold mining. I've chased physical gold. It's a lot of work for very little return. But once the gold is assembled by other people, then I'm happy enough to attack that source of gold, to attack where the gold is located. I want other people to do the hard work to give me the opportunity to move into that area. That's the overall strategy that I use. So when I talk later on about how we find trading opportunities, I'm not working as a gold miner. And later on, some of the other speakers will work on that perspective. They'll have particular tools and techniques that will allow them to identify opportunity before anyone else. My focus is on identifying when the gold has been discovered, where it's going, so that I can join some of the journey and some of the trip. So what about markets themselves? Where do we start thinking about the market? We tend to be technical analysts. Most people tackle the market from a fundamental perspective. We don't have to agree with what they're doing, although many of us will incorporate some of that into what we're doing. But it's useful to work out the basis from which they are starting. Often their reference, the foundation reference, Warren Buffett and others, is Benjamin Graham and David Dodds. It's a very, very useful book. It has one problem. In 1939, the book on the left-hand side was published on how to fly a Spitfire. Now, of course, flying a Spitfire is a very important job at that particular point in time. Dodds and Graham's security analysis was published at the same time. The principles of flight haven't changed. The principles of the market haven't changed. But if I'm trading today's market, I would not rely on the pilot's notes for a Spitfire. I'd be looking for something that's going to allow me to fly an F-15 or an F-20. So Dodds and Graham is an important starting point for many people in the market. And if we're trading stocks, that provides us with an advantage because the markets have moved on, but they haven't necessarily moved on in terms of their thinking. So who are our new trading opponents when we look at today's market? I need to know these because this is who I'm trading against. This is the battlefield. The most significant changes that have taken place are exchange-traded fund trading, algorithmic trading, and to some extent, high-frequency trading, although the impact on high-frequency trading is probably less than it was 3 or 4 years ago. ETFs are one of the major changes that have taken place since 2008, and they have changed the nature of the battlefield. The ETF is essentially holding up the market. ETF trading, in many cases, has become the market. So, for instance, when we're considering trading gold, the gold ETFs are the largest holders of gold after 7 sovereign nations. Think about it. When we were trading gold 4 or 5 or 6 years ago, we were trading gold in an environment where the bulk of the gold was held by the 7 largest sovereign nations with a few others thrown in. Now it's 7 sovereign nations plus the next largest group is ETF. Sovereigns hold to invest. ETFs hold for trading, and this alters the supply and demand balance in an important way. And I'll just briefly look at this. Let's say, for instance, that we held stocks A, B, C, and D. And we decided that stock B wasn't trading particularly well, therefore we would sell it. No other action was taken with stocks A or C or D. However, when we look at an ETF, the situation is different. And this is important because it explains some of the changes in volatility that are taking place in our markets, which in turn changes the tactics that we must use. So the ETF, coincidentally, is also holding stocks A, B, C, and D as a single basket rather than as individual holdings. So when I send a sell order to the ETF doesn't sell just the worst performing stock, stock B in this particular instance. It must sell stocks A, B, C, and D in proportion so that the balance or the distribution ratio remains the same for the total ETF holding. So what's the result? The result is that it isn't just stock B that goes down, stocks A, C, and D go down, even though there is no fundamental reason for that sell-off to develop. It means that stocks in a strong trend may suddenly, for apparently no reason at all, suffer a sell down and a break in that trend as a result of ETF consolidated selling. So what this does is it fragments the relationship between buyer and seller. It deprives the lit or public market of information. It increases volatility in individual stocks because when an ETF gets a sell order or a buy order, the good goes out with the bad in the rebalancing. It tends to accelerate the sectorial trend behavior. That's a change in the battlefield that we didn't see 10 or 15 years ago. It's a change in the battlefield that many people still don't fully understand. They're still trading with Dodds and Graham or the Spitfire manual. Algorithmic trading is usually seen as one of the major changes that's taking place. The jury's still out on algo trading. There is no doubt that it becomes a powerful force trading to which we must trade against. Many of us will develop and are developing our own algos to be able to trade in that particular environment. I think one of the major impacts that are coming through is the need for rapid trade analysis and execution, that we have a commoditization of trading that's taking place, that value concepts are overwhelmed by transaction speed and by trend instability. Algos bring in the transaction speed, trend instability is increased by the behavior of ETF trading. It means, ultimately, that we cannot trade the fundamental or true value or moves away or towards that. We must trade the market value. And when we're in that environment, that's good for exchange-traded fund trading. That's the way I see the modern market battlefield. It's against that background that I apply my strategic analysis and reach in for particular tools that will allow me to do that. And I have a couple of favorites, and I'll share them with you. I am essentially a chartist, as distinct from a technical analyst. In other words, my first stop for every trading decision is the chart, the naked chart. No lines, no moving averages, no other indicators. I want to see what the chart action itself is telling me, and then I will dress the chart with trend lines and other pattern recognition. The most powerful and reliable long-term pattern that I find in the markets is the head and shoulders reversal pattern. Here's a good example. This one happens to be Shanghai market. It also applied to the Dow in 2000, going into 2008, into a variety of other markets. Its reliability is very high. So when I see a head and shoulder pattern developing, then it tells me I need to protect my long positions, be more cautious in opening long side positions, be ready to take shorter term trades in anticipation of the market turning down, and be ready to move quickly to take short positions in anticipation of a continuation of a long-term secular downtrend. Head and shoulder patterns in a strategic analysis are best seen on a weekly chart where each candle represents 1 week. The difference between the left-hand shoulder, the head, and the right-hand shoulder, the difference between the shoulder and the peak is normally measured in weeks or sometimes months. In this example, you can see that the left-hand shoulder is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 12, about 14 weeks. The right-hand shoulder is completed in about 6 or 7 weeks. Key measurement factors. The base of the shoulder is connected with a single trend line. The distance between that trend line intersection and the head is measured, and that value is projected downwards. It gives about an 80% reliability. In other words, When the market breaks below that trend line, there's an 80% probability that the downside target will be achieved. In a severe bear market, you can take that downside target and double it. And you can trade that as an independent trade by itself. But my purpose, it's like Rommel looking at the map. This is the map of the battlefield that I'm going to be working on. It tells me, as the market moves below that trend line, that this now has a high probability of a long-term secular downtrend, that trades ought to be on the short side, that any trades I'm taking on the long side are counter trend, need to be managed more closely, more effectively with tighter stops. It gives me the longer term view of what's happening in the market. And that's purely from the chart, without using any type of technical indicator at all. But there are some markets and some instruments that are particularly compatible with the relative strength index. This is the way that I prefer to use RSI on a strategic basis. Now I've moved back to a daily chart in this instance. So the weekly chart's giving me an idea of the broader battlefield. This is giving me a specific idea of where I'm going to be fighting. The RSI divergence that I'm looking for, and the way in which I use it, as you can see on the left-hand side, the trend line is placed along the lows of the price chart in the upper section and along the lows of the RSI, but the only valid points on the RSI are those points that are below 30. When I've got a divergence pattern there, it's telling me there's a high probability that this downtrend is going to end, so I'm prepared to trade those breakouts with much, much more confidence. The same on the RSI divergence on a bullish environment. Here, the initial line on the RSI on the price chart is placed along the top, the peaks of that rise, and along the top of the peaks on the RSI. I want them moving in opposite directions, but the only peaks that are valid for my analysis are those that are above the 70 level. What happens in between 70 and 30 is merely market noise and has no strategic value for what I'm doing. So three types of divergences. The strongest is on the left-hand side, where both the price activity has a clear downtrend in place and the RSI activity has a clear counter trend in place. So there's a clear divergence between the two trend line activities taking place on the chart. The next strongest is where the index has created a horizontal rebound level, but the RSI is showing a divergence with an upward sloping trend line. The weakest of the divergence patterns is where the index is moving upwards, but the RSI index is moving sideways. So working from left to right, the left is the strongest divergence pattern. That's the one where I'm interested in trading breakout environments on the individual stocks or commodities I'm dealing with, because there's a higher probability that those breakouts will be successful. If I'm looking at the relationships I see in the right-hand side, I'm still fairly confident that the breakouts will be developing, but I'm looking for additional confirmation to confirm that those breakouts are successful. That tells me how I'm going to fight, where I am on the battlefield. Then I need to be able to select the candidates that I'm going to trade. How do I develop the pool of potential stocks from which I can extract those which are going to be the highest probability trades, moving in a way that is consistent with the market, in a way that is consistent with the breakouts that are taking place and the general trend direction. Pool design, the key thing we need to remember right from the very word go is that we need a deep pool of money. There are lots and lots of opportunities that come up on a pure technical scan. Not all of them are tradable. We need a pool of money and a large crowd to be able to trade with. If the liquidity is not there, we cannot execute our strategies. They may develop perfectly, but if we can't get in without moving the market and we can't get out without moving the market, then the trade is either unsuccessful or exceptionally difficult to be able to manage. So at the back of the mind, no matter what method we use, we need to remember that we're looking for a deep pool of money, deep liquidity, and that usually comes from a large crowd. The larger the crowd, the better the probability that someone in that crowd doesn't really know what they're doing. I don't really want to trade against a pool of experts. I want to trade against a pool of people who are perhaps a little less experienced. It gives me an edge. So where's the traditional pool gathered? Most people will be looking at Dodds and Graham or the derivatives of Dodds and Graham, and they'll be looking to their brokers to be able to give them advice. Now, this is useful. It brings in a crowd of people, and with that crowd comes a depth of liquidity. But it's not very useful. The picks that are made by the brokers are not much better than a coin toss, and sometimes seriously worse than a coin toss. Back in 2015, beginning of 2015, we took a list of 15 recommendations from the top brokers in Australia. These were published in the mainstream media. And we tracked their performance between 2015 up until just a couple of weeks ago. So these are up-to-date figures. Over the 3 years, only two, let me say that again, only two of those recommendations in 2015 were in profit at any time at all. 2 out of 15. That's far, far worse than a coin toss. Of course, on the downside, different story again. 6 of those recommendations had 30% losses. 4 of them had 50% losses. 3 of them had 75% losses. And of course, as with most brokerage recommendations, there was never a sell recommendation listed for any of those stocks that consistently lost money over that period, 2015 to 19. So the pool that's created by brokers' recommendations is a pool of fools. And a fool and their money are easily separated. That may sound a bit mercenary, but that's the way the market works. So this is always interesting to look at, to see those recommendations that are coming through, because we know that a crowd of relatively unsophisticated investors is going to be involved. There are opportunities to make money there. So it's a good starting point, but I will assess what's in that pool on an independent basis. Of course, we can do it yourself, and other speakers will talk a great deal about the methods that they use. But I've found it doesn't really matter. It doesn't matter if you use a 1030 period MA crossover, Bollinger Band compression, RSI divergence, stochastic crossovers, new 5-day highs. All of these are pretty much equally successful. What's important is how you narrow that pool down to a smaller group of stocks so that you can make better selections. Always bearing in mind that if there is no volume or low volume, you cannot trade. If you are trading in a low volume, low liquidity environment, you will be left high and dry. The ship may be perfectly seaworthy, but without the water, it doesn't float. Remember how you want to be. Generally, this type of approach, I call it the do-it-yourself approach, using an algo approach, using these types of searches, is the equivalent of the gold miner. You're really trying to find opportunities before other people find those opportunities. That's a very difficult thing to do on the market. There are hundreds and thousands of people who are looking at exactly the same charts that you're looking at exactly the same time. And amongst those hundreds of thousands of people, there's going to be an inevitable number that are faster, quicker, smarter, and more experienced than you are. I don't necessarily want to go head to head with them. If I'm prepared to trade in environments where there is lower volume and a smaller crowd, then I can develop an advantage. But where I'm looking at these technical results, these searches that are done, and are moving into big crowds with deep liquidity, then that's an environment, a battlefield that's populated by people who are highly skilled at picking those breakouts, at trading those sorts of moves. On the other hand, if I'm a pirate, which is what my preference is, what I'm interested in is where the pool is gathering so that I can assess the value of that pool. I'm interested in the pools that are created by these sorts of searches. And I can use slightly different methods to discover where the crowds are gathering and then decide how I want to trade in that environment. The one thing I know for sure is that I am not smarter than the market, and I am not smarter than most of the people in it. So therefore, I have to look at different sorts of advantages. Now, the third one down here in this do-it-yourself approach is specific mathematical conditions. This is developing more and more as algo trading comes into the market. Specific mathematical conditions come into markets that are more dominated by mathematical decisions, derivative markets, for instance. So we can look, and we do look, for some very specific relationships. And this is a key relationship that we apply to our trade selection in foreign currency, commodities, and index trading. There is a statistical relationship that is established, that is consistent, and that gives us consistent results. It starts with the 5-day average range of price. That is the difference between the high and the low over 5 days. So for instance, we're showing here, day one is 100 pips, 110 pips, 95 pips, 90 pips, 105 pips. Total that, divide by 5, it's a simple average, 100 pips. What's that telling us? It tells us that there is an 85% probability that the next day's trading will achieve 75% of the value of that 5-day average range. We find this incredibly important, so I'll say it again. There is an 85% probability that the next day's move will be equal to 75% of the value of the 5-day average range. We've been trading this for the last 4 or 5 years. This relationship consistently remains in place. This analysis doesn't tell us which direction the market's going to go, whether we should be long or short. And we use other techniques, which I'll discuss in a moment, under pool filters, that allow us to determine that. Once that trade is entered, once the entry signal is generated, then there is an 85% probability that 75% of that 5-day average range will be achieved. In this instance, in this example, 75 pips out of the 100 pip move. And we find in over 5 years of trading that in fact our average of entered trades is currently at 86.5, slightly better than what we got there on a statistical basis. So just to very quickly recap, we can let someone else do the work for us and then look at what they're chosen and make our own analysis of those opportunities. Large crowd, lots of money, deep markets. We can do our own technical searches, and there's no search that performs outstandingly. It depends on what your particular objective is, whether you're a gold miner or whether you are a pirate. Once you've got that, you need to remember in the assessment, no volume, no trade. You want significant volume, good liquidity to be able to execute the trades both going in and out. And the third method is to look for specific mathematical relationships. Now, there are a whole range of those. In our particular instance, we look at 5-day average range and we find that that is particularly effective for foreign currency trading. Having done that, we then have to decide how we filter that pool. Out of the thousands of opportunities that are available, we've decided to select just 2 or 3 trading opportunities. That's the hard bit. So how do we go about it? Well, let me ask you a question for a start. And unfortunately, I'm not going to see your answers. What's the correct time? 12 minutes past 10 or 8 minutes past 10? And again, I can't hear your answers. Most people will say that the correct time is 12 minutes past 10. And they say that because they are using a weight of evidence approach. So we've used, for instance, 1, 2, 3, 4, 5, 6, 7, 8. We've used 9 different technical indicator searches. And they've all come up with 10.12. So therefore, 10.12 must be the answer. If you look more carefully at this particular display, most of the watches are digital. One is an old timepiece. We're all measuring the same thing, time in this particular instance. But we have time measured in 2 different methods. A mechanical watch and a digital watch. When I get agreement between 2 different methods, when I have confirmation using 2 different methods, then I have more confidence that that's the correct answer. 600 people giving me the wrong answer does not make the wrong answer right. Of course, 1 contrarian idiot giving me a single answer and a single answer doesn't make that right either. We need to take a couple more steps beyond that. But this underpins the way that I will now move to filter the list of stocks or commodities that I'm looking at. I want to analyze them in ways that are using 2 different methods to measure the same thing. I'm not looking for weight of evidence. I'm looking for confirmation of evidence. It's a very important difference. My first tool is a Guppy multiple moving average. And I'm going to move through this fairly quickly because I'm making the assumption that most people are pretty familiar with GMMA. It's a common display these days, and I've seen all sorts of variations. The objective, of course, is to get the entry signal as near as possible to the pivot point low of the downtrend, in this case, before it turns to an uptrend. We also want to avoid false signals. This particular display here shows 1 set of false signals on the left-hand side. We have in the middle, in the enclosed square, we see a crossover that takes place between the 3, 5, 8, 10, 12, and 15 exponential moving averages. I left the 12 off this screenshot for some reason. We are seeing both a crossover that takes place, a compression, an expansion, and a change in direction. What this tells us is that there is a change in the understanding of the relationship between price and value. That's the key to understanding this. For convenience, we label the short-term group of moving averages as traders. It's just a convenience. We can't really tell who's making a 3-day moving average or a 5-day moving average, and if they're a trader or an investor. It's just a convenience way of understanding and thinking about these behavioral relationships. In actual fact, it's a fractal repetition that takes place in the market, and that's vital for understanding the market behavior. The crossover, the compression in the moving averages, shows that there is an agreement between the price and the value, the way that people are thinking about it. They're saying, yeah, this is worth $7. And a whole lot of people across a whole lot of different time frames think, yeah, it's worth about $7. The only way I can buy it at $7 is to bid slightly higher than my competitors. Otherwise, I won't get a position. So we see the expansion that takes place in the short-term group of moving averages. The compression and the expansion. Compression is agreement about price and value. Expansion is disagreement about price and value. Take the next step. Let's move those group of moving averages out. We extend it to 30, 35, 40, 45, 50, and 60 EMA. Again, apologies for having two 50s there. This is a much longer group of moving averages. For convenience, we say they're investors. But look at the behaviours. The behaviours are exactly the same. We have this compression that takes place, followed by an expansion. The compression shows us that there is an agreement about price and value. It tends to be an agreement with longer-term traders and investors. For convenience, we say that this is the way that investors are thinking. Investors, that's the big pool of money. Investors is the larger crowd. Investors are the people that support this developing trend. They are the ones that are going to give us the opportunity to buy without moving the market. In other words, we can simply execute our buy order without having to bid higher to be able to get in. And these are the ones that are going to give us the depth of liquidity to be able to close the trade as well. Investors, the longer term holders, are really important. Of course, it's the same old story that it's always been. The pivot point low, which we'd like to get in as close as possible, is a long way back from the signal that we're getting from the long-term group of moving averages. The advantage, of course, is that the longer-term group avoids false signals. We still get them, but not as frequently. The interesting thing is when we combine these two displays, because what we get is an entry window. And the way that we choose to trade that entry window will reflect the tactics and whether we are aggressive or conservative in our trade approaches. But I want you to notice one thing. The shortest of the moving averages here is a 3-period moving average. The longest is a 60-period moving average. And yet, we can see the compression behavior and the turning up, the change of that trend taking place within just a couple of days, if this is a daily chart. We have a clear entry point taking place here. Our entry window gives us 3 ways to enter this trade. First, we can enter it very early on. We are aggressive. We can see the change that's taken place in the short-term group of moving averages, the compression, and the beginning of compression in the long-term group. There's no lag here. The compression that's taking place here takes place simultaneously with the compression that's taken place in the short-term group of moving averages. If we move back to here, for instance, here's compression in the short-term group. Nothing happens in the long-term group. We wouldn't even bother acting. It's this simultaneous compression that takes place in this short-term group and the beginnings in the long-term group that allows aggressive traders to enter this trade. For me, aggressive means entering in anticipation of the trend change. A conservative trader will enter back in this region here. He's waiting for confirmation of the trade development. And the confirmation comes from the compression in the long-term group and the way that the short-term group has remained above the long-term group. There's been a small pullback here. This has now acted at a support level and there's a continuation. Conservative traders enter in this environment with a high level of confidence. My preference is to enter here, but most of the time I end up entering somewhere in this region here. It's still fairly close to the pivot point low, but it's not delayed unnecessarily. Here, the treasure ship is in full view. I can trade into here with a high level of confidence that this breakout is likely to continue. Later on, if I've missed this entry, and that often happens, we can enter into these pullbacks with a high level of confidence that the trend is likely to continue. Oops, let me just go back to that. And we do that because the third set of relationships is the relationship between the long-term group and the short-term group. Here, the degree of separation between the two groups is steady and consistent. That tells us that the trend is also steady and stable. It tells us that it is relatively safe to buy on the pullbacks in anticipation of a rebound and trend continuation. It's the degree of separation in the long-term group of moving averages that gives us essential signals about the stability of the trend and the likelihood of this trend continuing, which was a perfect solution up until a few years ago. As ETFs became more active in the market, we ended up getting volatility wipeouts. I refer you back to our earlier screen where we said when our sell order goes into an ETF, then all stocks making up that ETF are sold down by equal ratios. And this has a corrosive impact on established trends. We need to adjust our trading styles slightly. But before we move on to that, just one important proviso. We're using two sets of moving averages, 3, 5, 8, 10, 12, 15 moving averages, exponentially calculated. We're using a long-term group, 30, 35, 40, 45, 50, and 60 exponential moving averages. Our purpose is to get an entry as close to the PPL, and the PPL is the pivot point low of a trend or the pivot point high of an uptrend before it turns to a downtrend. The golden fleece, the golden objective of every trader is to identify the PPL first. We spend a lot of time trying to do that. That's a gold miner's approach. The pirate's approach says, let's see that in retrospect, let's see how much gold has been gathered, and let's then see how we can join that golden armada. But 3, 5, 10, 12, 15 moving averages. It doesn't specify the time period. This is the key factor. This could be a daily chart. It could be a weekly chart. It could be a 1-minute chart, a 5-minute chart, or a 10-minute chart. The same relationships are repeated across multiple time frames. This is an application of chaos theory within a market environment. I'm trying to identify where the strength is located and the strength of that particular strength. Once I've got that, then I'm looking for an independent and different method to verify the entry point. Remember, I'm not looking for confirmation for things that are measuring this in exactly the same way. A stochastic, moving average crossovers, RSI, I can use all of those sorts of tools. They will give me a similar sort of answer because they're measuring similar sorts of things. Here I'm measuring the psychology of the market, the changes in behavior, the changes of thinking about price and value. Now, before I can confirm an entry, I want to try and measure it in a different way and get a confirmation. And for that, I use a countback line. I'll just go back for a moment. I talked earlier about the conference, the Traders Conference in Kuala Lumpur. GMMA came out of the sort of work that Linda Raschke was talking about. This, to me, is the music of the market. It's different from Linda's concept of music, and she's a far more accomplished musician than I will ever be. But this is the music of the market for me. This is what allows me to understand what's happening. So then I talked about Joe Stowell. And Joe Stowell introduced a concept that is similar to the countback line. Countback line modifies it to some significant degrees, which is why we gave it a different name to distinguish it from Joe Stowell's 3-bar net line. This is the way it works. We want to identify, as we were talking before, the pivot point low as close as possible. We want to try and get in as close as possible to the pivot point low. There's still a bit of gold miner in me at heart. So what I'm doing is I'm following this downtrend. And I want a signal that tells me with a good probability of success that this rally that's taken place is the beginning of a new uptrend. I want to understand the volatility behavior. Now I can do that with Welder's ATR. I can do it through a couple of other methods. But I find that they don't necessarily adjust as effectively to changes in volatility. This is a simple chart-based method. Can be automated. I tend to still do it by hand. So this bar here, this last candle, turns out to be the lowest low in this downtrend. But I need a confirmation of that. So what I do is I move to the top of this candle, across to the left to the next candle that's higher, cross to the left to the next highest candle, to the top of that candle, and draw a line to the right-hand side. That's the countback line. That's the trigger line. Now, two things that are important. This is not 3 bars. It's not 3 candles. It's the top of from the top of this candle across to this candle, ignoring any candles that are lower, across to the next highest candle, ignoring any candles that are of equal height, and moving to the next highest candle. So it's 1, 2, 3. Counting back 3 higher candles, and that can be programmed quite easily. We draw a line to the right-hand side. What I'm looking for is a close above that value, not an intraday high above that value, but a close above that value. Once I've got a close above that value, then that is my entry signal. This can be used as a standalone technique, if you wish. And we often use it in some circumstances for standalone trading, using purely countback line as an entry and exit signal. However, what we do is we've started with the GMMA. That's given us an indication that a trend change is developing here, and we're aggressive. We then apply a countback line, and once we get a countback line entry signal, then we will enter the trade. That may be, let's do it here, 1, 2, 3, that's in this environment here. It might be here. The GMMA tells us it's time to prepare to attack. The countback line tells us this is when we do attack. Now we can use a countback line as an exit method and as a trailing stop loss. Is a self-adjusting volatility stop. It doesn't use a 3-day average or a 4-day average or a 5-day average. It doesn't use a set period like ATR. Instead, it uses the combination. So for instance, here we're using as a trailing stop. We've come across, we've taken the current highest candle in the uptrend down to the bottom of that, move to the left to the bottom of that, ignore equal lows, across to the next lowest low, and there becomes our trailing stop loss. We can do this as the trend continues. We can calculate from this high and from this high and from this high. Sometimes the number of candles involved will be 4 or 5. At a minimum, it will be 3. Sometimes it can be 5 or 6. It's self-adjusting. It depends upon the changes rather than a preset calculation of volatility. This gives us a way to manage the trade. Here's a good example. It doesn't matter how long we've traded for. The reality is that every time we enter a trade, we pretty much hope that we've made the right decision. As the trend begins to develop, we become more confident that we've made the right decision. And eventually, we reach a point where we're certain that we've made the right decision. For new, less experienced traders, these become very significant points. We can go from hope to confidence to certainty. For experienced traders, they're points we recognize subconsciously. And we grow more comfortable as the trade develops. With an algo, it doesn't have any clues whatsoever. So here's our first entry point. Here's the lowest low in this current downtrend. There's our countback line. Cross to the high, to the next highest high, across to that, to the next highest high. In this case, it covers a period of 1, 2, 3, 4, 5, 6, 7 days or minutes or whatever. This can also be applied to a chart on any time frame, a weekly chart, a daily chart, a 2-minute chart, a 5-minute chart. We draw a line to the right. That's our countback line. There's our entry signal. On the day we make the entry, we calculate the new countback line. So we go from the high of this day to the next lowest low, down to the next lowest low, and this becomes our stop loss line. Every time a new high is made, the stop loss line is recalculated. So for instance, from this high here, we go to the bottom of that line, across to the left to the next lowest candle, across to the left to the next lowest candle, and our stop loss line would be moved upwards. So the stop loss line steps upwards following price activity. So we've entered one trade. Let's hope. We can scale in if we wish. When we look at this high here and do our countback line calculation, bottom of the candle across to the left, down to the next lowest candle, this is the first time that the stop loss value is higher than our entry price. We can have much more confidence that this trend is now developing fully. We can confirm that with the behavior we see with the GMMA as well. We buy our second point here if we're scaling in. If we want to take a third scale in, we use the same procedure. Here's our next highest high where the countback line calculation is higher than the previous entry point. So we go from the bottom of this candle to this candle to the bottom of that candle. Here's our third stop loss, which is higher than our entry point on our second trade. So we enter for our third position here. Now, my preference, if I'm allocating $20,000 to a position, for instance, I allocate all of that capital in my first entry. But I still follow this because it helps me to develop confidence and certainty that I've made the correct and successful decision. These stop loss points will continue to follow the trade upwards until an exit signal is generated. And that may be up here. All the time, we're assessing this against the strength of the trend as shown by the GMMA relationship. This is a strong trend. Price is clustering on the upper edges of the short-term group of moving averages. There's strong trading activity. Investors are strongly supporting the trend, and our countback line exit stop loss would follow this up consistently until an exit signal is generated. In this situation, I'm not setting an upside target for my exit. I'm looking for a set of indicator conditions to set that exit condition. Sometimes I will trade on a target and a time. We talked about the use of the 5-day average range as a trading technique, the 75% probability of hitting 75% target. We can trade, on this case, on a 2-minute chart, GMMA, we're looking for a 60 pip return, and that's achieved within a very short time. Or we can trade for a continuation of the trend, in this case, GBP AUD, which gives us a 500 pip target. I'm just looking at our time, which is a little bit shorter than I've looked at. So, execution. We have a choice. We can use price leverage or we can use instrument leverage. Sometimes I trade low price stocks and commodities. This is a trade in lithium as China began to announce rare earths or the potential for rare earths quarantines taking place. This particular stock returned 140% over 5 or 6 days. But normally, look at this, here's a trading band environment. If we trade the physical, it's a 5% trade. But if we trade this via a CFD or a derivative, there's a 35% return. So our execution is done where there is deep liquidity, where there is a good crowd, and where we can get either instrument leverage or price leverage. So here are my rules for rules-based survival in the market. I'm looking for pirate opportunities. Let someone else do the hard work. I'm then applying strategic analysis, and I'm looking for 2 independent confirmation tools. My tools of choice are Guppy multiple moving average and countback line. I'm wanting deep pools to trade in. I want deep liquidity. I want a large crowd, because within that crowd are people with a variety of skills. Some of them will make mistakes. That may give me an advantage. I'm looking for independent verification. Count back line, GMMA. For trade exit, I'm either looking for indicator conditions, in other words, a GMMA exit signal, or a count back line exit signal, which is then verified against what the GMMA is telling me, or I'm trading for a target or a time. Target trading, I've entered the trade. I know that there is a 85% probability of achieving 75% of the 5-day average range. When price hits that 75% target, I will tighten the stops exceptionally to protect that 75% target and trade a little bit higher if necessary. My execution uses derivative or price leverage to maximize the return. Liquidity allocation has a major impact on the ability to execute equity trades. Increased volatility calls for faster execution as time in the market becomes the most significant risk. Short-term leverage trades are combined with volatility management in deep liquid markets. Algos and ETF reduce the impact of psychological behavior in the market, but increase the efficacy of statistical solutions derived from mathematical impacts on trading. We do produce a weekly newsletter that looks at changes in techniques and approaches that are suitable for the current market. We also look at weekly foreign currency trading notes that are based on the algo trading, not the algo trading, based on the 5-day average range trading, GMMA, etc. Thank you very much for your time and attention, and I'm very happy to take questions.
Daryl, thank you so much. I have sent your link, the offer link that you're offering, to everybody in the room. Make sure somebody just tell me if you guys got the link. Just confirm that in the room here. You know, there's just so much in this information that I really recommend you guys either watch this on demand one more time, or actually, I believe there's a PDF here that you have that you could look at this presentation in peace and quiet of your own review. The thing that really blew me away here, that I think is so interesting from a trading point of view, is the combination of short to long-term moving averages and the use of those, and the whole idea of sort of separation and compression of moving averages as a way to time the entry zone. That's an incredibly interesting idea, applicable to lots of different markets. There's one question, because of the limits of time, I really only have time for one question. And the question I think that came through the group that was interesting was, is your approach applicable to all markets? And specifically, there was a question whether you could use these methods to trade the FX market. I have an idea that the answer is probably yes, but I'd like to just confirm that from you.
Yes, the answer is yes. We apply this GMMA analysis and CBL management to foreign currency markets, to commodity markets, to oil, to gold, to index trading, to equity trading. We find that they deliver the same levels of success in US markets, Australian markets, Singapore, Malaysia, China, across the board. Because, first of all, we're trying to track the psychology of the market. That comes through the GMMA. We're not interested in the statistical crossover. That's unimportant. What's important is the psychological messages it delivers about the way the market's thinking, and that applies across all markets. And then we're using a countback line, which is adjusting to the volatility, the individual changing volatility of any particular market that you're trading. So yes, we find that they are universal, and we've been using those methods for 25 plus years with a good level of success.
Great. So the final question that is interesting here is, because you don't have hard exit targets, because you're essentially coming into every single trade open-minded and saying, I really have no idea how much money this trade can make for me. The corollary to that is typically, how long do you hold your positions? What's the average hold time of these type of trades?
Okay, there are the two parts of the answer to that, Boris. The first part is that when we're trading currencies and some commodities, and we're using a 5-day average range approach, then we do have a defined target, and that's 75% of that 5-day average range, and an 85% probability of that being achieved. So in those types of trades, we are trading for a defined target. In the other sorts of trades, the newsletter is probably the best way to look at that. We've been running that for more than 20 years. The average holding period is about 21 trading days.
Interesting. Okay. All right. That's good to know. It's very, very interesting. So basically, that's sort of the maximum expansion from
sometimes it depends on market conditions. Sometimes it's a bit longer in good, strong bull markets. Sometimes it's a bit shorter in bearish markets with increased volatility. But on average, over that 20 years, it's currently about 21 market days. So about 3 weeks.
Great. Okay, well, I want to thank Daryl very much. He has actually taught me tremendous amount of information in this webinar. Most interesting, for those of you who are watching this, is the insight into how algos have changed the actual mechanical trading of markets, which explains so much about the irrationality of today's markets, and actually makes them quite rational when you understand how the mechanics have changed. We're actually going to explore that theme more and more as the show goes on, but I really wanted to thank Daryl for kicking this off and giving us a great overview and a specific trading advice of his strategies. Thank you again. Everybody, please take a look at his offer. And of course, all of this information will be emailed to you in a post-event email. So relax. All of this information you will be able to get within the next couple of days as we get it all collated and get it to you together.